Welcome to the 10th episode of Talks with Daulat. Daulat is a tech-enabled all-in-one solution that provides customized portfolios to Indians so that they can invest better and reach their financial goals. Today we have with us the founder and CEO of Daulat, Varun Fatehpuria. Before Daulat, Varun worked with some of the biggest investment firms in the world like Bloomberg and Blackstone. He graduated with distinction in finance and information systems from Hong Kong University of Science and Technology. He is also a NSIM certified investment advisor. We're glad to have you here with us, Varun.
Thank you so much, Akshita, for having me once again.
So today we are going to talk about something very exciting. Today we are going to tell you about Cash Plus, which is our cash management solution. So Varun, first, can you please tell us what exactly is Cash Plus and what is the idea behind it?
So, Cash Plus is Daulat's proprietary cash management solution that helps individuals and corporates alike save for their short term goals, short term money better. We as individuals have become really accustomed to keeping our shorter term money in a bank account or a fixed deposit, primarily due to the familiarity associated with these options. Obviously, it is easy. We do not really have to rack our brains as to where we keep this money. So naturally, we go and give this money to a bank account because at least we are assured that we'll be able to get this money when we require and it is safe, right? But the returns that these instruments have been able to provide are anything to talk about. What we have really seen in the last year, year and a half, the RBI has increased the repo rate, the interest rate by 250 basis points or 2.5%. Unfortunately, that has not been transmitted by the bank to the depositors in the form of a higher interest rate. We are still stuck at a meager 3.5% rate of interest that we earn on a deposits kept in a savings bank account, or a 6.5% interest that we earn on a fixed deposit with all sort of a lock-in and premature withdrawal penalties that is applicable to it. We think we can do better by taking it a step further by delivering significantly higher returns while keeping the safety and the liquidity aspect of both of those options intact. So that is what Cash Plus is. We help you save your short-term money better and reach your shorter-term financial goals in a much more efficient manner. So whether that's saving for a home loan down payment that's coming up in the next 3 to 6 months, or if you're saving up for a vacation that you want to take in the next year, this is the solution for you. You can invest in a cash plus portfolio that will help you earn a significantly higher return than what you earn in a bank account or a fixed deposit while being extremely safe and highly liquid.
Okay. But where exactly, when money is invested if we are availing Cash Plus?
So Cash Plus effectively invests in a dedicated and a curated portfolio of three dedicated mutual fund categories. Number one, liquid fund. Number two, an ultra short term fund. And number three, an arbitrage fund, which is effectively a debt like fund but enjoys a favorable equity taxation. So just like how when you keep your money with a bank, whether that's in an account or a fixed deposit, that bank money is not effectively sitting idle. The bank lends that out to thousands of different individual borrowers and companies. In a similar fashion, when you invest in a cash plus portfolio, these mutual funds hold securities which are issued by highly rated central or state government issuers or corporate entities, right? These invest in fixed income securities like commercial papers, like certificate of deposits, which mature within a period of 3 to 6 months. So, by investing in a cash plus portfolio, you are investing in a portfolio of securities that is much more diversified rather than keeping your money in a single bank account or a fixed deposit.
All right. And if you could talk a little about the risks that are associated, with the money that we're investing using Cash Plus.
So, as we have continuously talked about, any debt instrument, whether that's a debt mutual fund or a bond, if you're investing directly, are exposed to two key risks. Number one is the credit risk, which is basically the risk that the issuer will fail to pay its obligation, the principal obligation or the interest obligation on time. And number two is the interest rate risk, which is basically the risk that arises from fluctuations in the interest rate in the economy. So, as I talked about in a cash plus portfolio, we only select the best funds which further invest in the highest and the best rated AAA rated companies like a central government bond, a state government bond, or a corporate bond, which effectively mitigates the credit risk because virtually there is almost a 0% chance of a default by these companies. And number two is the interest rate risk. By keeping the duration of the portfolio short, and by that I mean that these funds effectively only invest in securities which mature within a period of 3 to 6 months, right? So, put simply, the shorter the duration of the portfolio, the lesser is the interest rate risk, and vice versa, only because there are, I would say, that much less time for things to go south. So the credit risk and interest rate risk is easily mitigated by investing in a cash plus portfolio because these funds only invest in the highest and the best quality papers and keeps the duration of the portfolio extremely short.
Okay. But Varun, if you could tell a little about the liquidity that is associated with the funds in cash plus.
So we all realize the importance of being able to have the money when you need it, right? I mean, that's the entire purpose of money. If you don't have the money when you need it, it is of no use. And that is why we have designed cash plus portfolios by keeping liquidity at its center. We realize the importance of liquidity, safety, and risk. And all of these three parameters are of paramount importance to us when we are constructing any portfolio. So today, when you invest in a cash plus portfolio, you can have your money instantly redeemed and directly credited in your bank account within T plus one working days. So let's say, for example, if you place your redemption order prior to the cutoff time of 3 p.m., you can be assured that the money will come directly into your bank account the following day within the next 24 hours. So no filling forms, no going from here to there, no sort of a lock-in premature withdrawal penalty, so on and so forth. The money is yours and it comes into your bank account directly, which is just a tap of a few buttons on your phone.
That sounds really fascinating. If you could elaborate a little on the returns that are associated with cash plus, what can investors expect?
So obviously, one of the biggest benefits why we have created such a portfolio is because it delivers significantly higher return than what you can get by keeping your money parked in a current or a saving bank account, or even for that matter, in a bank fixed deposit. Now, since Cash Plus is an investment product and not a bank deposit, there is obviously a certain amount of risk that it carries, due to which it pays out a higher rate of interest or a return compared to other instruments, right? Just like if you're investing in a bank deposit that is insured uh, up to 5 lakh rupees, and over and above that, that you're not really insured, and that is something that you need to keep in mind. But when you are investing in a cash plus portfolio, despite you taking a certain amount of credit risk and an interest rate risk, you are not effectively, I would say, exposed to the same kind of concentration risk that you are exposed to by keeping your money in a single bank account. So when we proportionately talk about the returns, depending on your investment time horizon and the risk that you can, I would say, stomach over a period of 3 to 6 months, cash plus portfolios today deliver returns anywhere between 7 to 8.5, 9%. Right? This is in tandem and moves in line with the interest rate in the economy. So in a period where the interest rates are rising, these investment products are very quick to transmit the higher interest rate to its subscribers, primarily due to it being a market linked product. Rather than, let's say, in a bank deposit, the returns are pretty much fixed by the bank. And they are extremely slow, as we have seen over the last year, in transmitting that rate hike to its depositors. So the cash plus portfolio definitely delivers a significantly higher return, but you need to keep in mind the investment horizon and the risk appetite that you can take for a period of 3 to 6 months.
Got it. And how does this compare with, say, investing in a current account or a fixed deposit?
So when we constructed a cash plus portfolio, we obviously needed to keep in mind some of the parameters where keeping your money in a bank account, whether that's a current bank account or a saving bank account or a fixed deposit, wins over. So let me just show to our viewers today what are some of the key parameters where a cash plus portfolio wins significantly over its competitors. So the three key parameters where I would say the cash plus portfolio wins over a bank account or a fixed deposit are: number one, on the return aspect. So it delivers significantly higher returns than what you're able to get on a savings bank account or a current bank account, right? So by delivering returns up to 7 to 9% compared to 0 to 3% that you earn on your current or a saving bank account, or the 6 to 7% on your fixed deposit, you're able to get a significantly higher return. So that's number one, the return aspect. Number two, there is no TDS that is deducted on the interest or the gains that you make in a cash plus portfolio as opposed to a fixed deposit. So as people would be aware, if you have invested in a fixed deposit for a period of 5 years, the bank every quarter will deduct a certain amount of TDS, irrespective of whether that money is credited into your bank account or not. So up until such point, you will actually have to pay tax out of your pocket, which is not the case with investing in a cash plus portfolio, where the tax incidence only arises at the time of redemption. So you get the added benefit of compounding by letting that interest compound over a longer period of time. And number three, where it wins again significantly, is on the taxation aspect, right? Where despite the taxation on the debt side of things being the same as a saving bank account or a fixed deposit, the arbitrage mutual fund enjoys a much favorable taxation in the form of an equity taxation, where shorter term gains are taxed at 15%, which is effectively for a period of up to 12 months. And if you end up holding these portfolios for a period of greater than 12 months, then the arbitrage mutual fund portion of the cash plus portfolio will only be taxed at 10% over and above gains of 1 lakh rupees, right? So at a blended taxation level as well, these portfolios win over your traditional instruments like a bank fixed deposit or a current bank account.
All right, got it. So, Varun, I definitely found Cash Plus extremely fascinating and useful, and I hope so did our viewers and listeners. I will see you again next week with another interesting topic for discussion.
Thank you so much, Akshata.